The KBE, that's the bank ETF, a record high again today, hitting its first record since November of 2024 yesterday. It's looking at its best week since last August. Names like Goldman, year to date, up 7.5%. We've highlighted every day. We have highlighted it every day. Morgan Stanley's up 5 to start this young year. Citigroup is up 4. Mike Mayo continues to have that as his #1 name in the group after a tremendous run in 2025. Stock up 66%. I bring it up and I focus on it because Jim Lebenthal, Farmer Jim, is trimming that name.
Got to trim it, Scott. You know, Scott, and I think everybody on the panel knows that I've been in this name for a long period of time. If you look at the last 2 years, its total return is almost 3 times that of the S&P 500. Scott, I really haven't trimmed this name. You and I were talking about things that I've trimmed. So this position has grown to be 6% of client portfolios, and that's just really large. I've trimmed it back to about 4%, which is still very large. So, Scott, I know you hate it when you kind of hate it when we talk about portfolio management. This is still a big position. I'm not backing away from it. What I am saying, though, is that this is not the same stock of a year or 2 years ago. 2 years ago, it traded at 60% of tangible book value. Now it's almost 1.3 times. It traded at 9 times earnings. It's now about 12 times forward earnings. Dividend yield was over 4%. Now it's 2%. I think Jane Fraser and team have done a marvelous job. There's still some heavy lifting to do. They now have done the cost cutting. They need to lean into those growth areas that, frankly, they have been leaning into. Investment banking and wealth management. I'm with them at 4%, which is a large position, but it's just not the same stock that it was 2 years ago, so I felt like I had to trim it.
You know, if I could add something to that.
Please.
What's so interesting about that a lot of people don't focus on is that when Citi had a stock that just didn't move, perpetually underperformed. Like I know when I was on the sell side, when I was on the investment banking side, 50% of my compensation was in stock. And the last thing I would do was go to a firm, a company, that had a stock that didn't perform. Now that they have a stock that's performing and a management team they can have faith in to continue that performance, their ability to bring in, as we've seen, top flight people is much improved. And that will add to the story.
Steve, it's a great point. As you were bringing that up, I thought you might mention some other levers that have been pulled because you were talking about stock price. And, you know, when the stock price was well below tangible book value, they did a massive accelerated share repurchase. They bought back over 15% of the company. And you've heard me say over the years that I love it when they're buying $1 worth of value for 60 cents. That's what they've done. Now we're no longer at a discount to tangible book value, so that's not a lever they're going to pull. You mentioned the leaning in that they've done, particularly wealth management and investment banking. Now we need to see the fruits of that. We're going to get the Banamex IPO this quarter. So I'm not backing away. It's still at 4%, frankly, a huge position.
But do you think the stock is still cheap?
It's not cheap. It's fairly valued. Now.
At 12 times.
At 12 times and 120, 125% tangible book value. Some people will say, I'll give this to you in a second. Some people will say, well, what about JP Morgan at over 2 times? You know, JP Morgan trades at a premium for a reason. Citigroup has to justify the premium now.
I think they will. Are you a premium to the group itself? Because it does not trade at a premium to the market.
To tangible book value. A premium to tangible book value. I'm still with it, Scott. Let me make it clear. I'm with it.
I don't have a problem inherently with portfolio management. It's kind of like no, you know what.
I know Sherlock. What you mean. I know what you mean. You hate it when we say, oh, it's a small position.
Well, obviously, it's portfolio management.
Yeah.
What I find peculiar on occasion is so you're trimming Citi, you're trimming Alphabet.
Yep.
You trimmed Win in late August.
Yep.
Stocks that have had great moves, and if the momentum is likely to continue, why get out or why trim points along the way like that?
I love the question. Okay, so inherent in what I'm saying, and this is true with Win, which I trimmed earlier, is my belief that
which was up a ton too.
Yep, and I trimmed it at 126. Now at whatever it is, 118.
Okay,
I'd love to buy that slug back. I really would. Win is a core position. I'd love to buy that slug back. It puts me in this perverse position of like I'd love to buy it back below 110, but do I really want my remaining position to go back below 110? This is the conundrum that we all face. And so what I'm saying to you, Scott, and everybody who's listening is I hate riding stocks up and down. I just hate it. And you know who else hates it? My clients.
Well, why'd you trim Alphabet? Let's focus on that. Because you, in many respects, are the face of that stock on our show.
Yeah.
Why do I say that? Because way back when, 8 months ago at this point, if not a little longer, you defended it more than anybody else.
Yeah.
The day that we highlighted what Eddie Q of Apple had said in the context of a courtroom where he pointed to search being down for the first time ever on the browser.
Yeah.
That's when the stock took a huge hit. Some had wondered whether that was an existential moment because it pointed to the loss of market share related to ChatGPT and all of these other large language models, which were taking pieces of the search puzzle, okay? You defended it more than anybody else, and rightfully so. It's one of the best comebacks, I think I said yesterday on the show, if not the day before, that we've seen in some time for a stock, especially one this large. It's knocking on the door of $4 trillion in market cap. It exceeded Apple in its size of market cap, too. Sometimes the story is, if not just getting started, has many, many more chapters to be written on a momentum scale.
You may very well be right. And maybe I should hang on to it. I'm going to tell you something very human.
Is this portfolio management too?
No, there's something more. There's something very human in this, and I'm going to wear my heart on my sleeve here. I'm actually proud, flattered that you've called me out on, that you have called me out on this, okay? And pride goeth before the fall. We all know that. We all know that. And I've thought about Alphabet a lot. Should I trim it? Should I just let it run? The right thing to do is put pride aside and be willing to get it wrong, that it runs to 400, 450, et cetera, and take a little bit of risk off the table. Now, let's go back to where we started the show. We're all saying we think the rally's broadening. Inherent in what I'm saying is I will find other stocks to pick. Oracle could be one of them that have gotten the snot kicked out of them the way Alphabet did back in May. I'm not adding to Oracle yet. It's a possibility. I don't want to wear too much pride and get smacked in the face, but I'm trying to pick stocks.
Here's how I look at it. First of all, I've been debating whether or not to buy more Google. Now, Alphabet. I sold low, right? Not all of it. I kept a vestige of it, and I added to it, so I participated. But I think here's how Jim looks at it, if I can analyze you for a second. Jim's a value investor, and he buys stocks that are in the dumpster. And so when they come out of the dumpster, when they've regained that value, he's getting out. So he's not looking at it from the lens.
He didn't buy this one in the dumpster.
No,
he held on at it as it looked like it might be going into
right,
one.
Right. But he bought it when everything was intact and it was substantially undervalued on a PE basis versus the other Mag 7.
It was 16 times.
Right, it was 16 times. So he still bought it when it was in the relative dumpster. On the other hand, I take a look at it, and I try not to have any view of where it was, but where it's going. And I've often said that. And that's why I'm thinking of buying more, because I think this is still going higher. I think that
that's what I'm questioning.
Yeah.
That's why I'm raising the issue. It's a conversation in some respects about investor psychology.
Yeah.
Trade school, a little bit on how to think about different positions that have gone up a lot, but getting out too soon because you get afraid, my word, not Jim's, that you might hang on too long.
You can't have any emotion, and I'm going to come to Jim's rescue because I run a portfolio.
It was an emotional move. He made admittedly an emotional move.
Well, what do you mean? I'm going to correct what he said.
Somehow the message got messed up there. I was trying to take emotion out of it. Emotion would have been, hey, I'm proud. Look what I did with Alphabet. I'm going to stick it out. I'm going to make Scott even prouder of me. That's the emotion that I was trying to avoid.
I got you. Okay.
So if we keep a maximum position
of sentiments, by the way. Got you, buddy.
If you keep a maximum position, you have to trim it. So I keep a maximum position of 5%. Microsoft, Goldman Sachs, these companies are two names that we've owned for 15 years. I trim them and trade them all the time, fully expecting them to go higher. JP Morgan was the most recent one that we trimmed. But it's not because of any loss of conviction on the name. It's just managing and budgeting risk. And I think that's what you were doing and hoping to accomplish in these trades.
It absolutely is. And I just have to sum this up by saying, ultimately, where I get my compensation, both emotionally and monetarily, is from portfolio performance. And these moves are about portfolio performance.
All right, so let's